Welcome to the deep dive. Today, we're getting into financial ratio and variance analysis.
Right. We've got some educational material plus real numbers for a couple of companies, G Company and Neostar.
Exactly. And our mission is basically to see how these tools help you figure out if a company's doing well or, where the problems might be.
And this stuff matters, right? Whether you're prepping for a meeting, looking at stocks, or just curious about business health.
Yeah, it gives you a lens. We'll try to keep it practical, focus on the aha moments.
Let's do it. So ratio analysis first.
Yep, ratio analysis. So what is it fundamentally?
Well, it's about looking at the relationships between numbers on financial statements, not just the numbers themselves.
Okay, so comparing things like sales to profit or assets to debt.
Precisely. It lets you compare a company over time or against its competitors or industry standards. You're looking for trends, strengths, weaknesses.
And there are different types, right? Profitability, liquidity.
Profitability, liquidity, solvency, and sort of performance or market metrics.
Let's take G Company's profitability in year two. Gross profit margin was 44.44%.
Meaning after the cost of goods sold, they kept about 44 cents of every sales dollar.
And the overall profit margin was 11.11%.
So bottom line, after all expenses, about 11 cents per dollar of sales.
Then return on assets, ROA, 7.2%.
That one tells you how well they're using their assets, like buildings and equipment, to actually generate profit. 7.2%. Okay, not super high maybe.
And return on equity, ROE, was 14.18%.
So how much profit they generated for every dollar invested by the shareholders? That's often a key one for investors.
Okay, moving on. Liquidity. Can G Company pay its short-term bills?
This is crucial. Their current ratio in year two was 1.03.
Which sounds like assets just cover liabilities.
Barely. And the industry average mentioned is 1.50, so they're quite a bit lower.
Right, and the quick ratio, that's even stricter, right? Excludes inventory.
Yeah, it focuses on the most liquid assets. G Companies was 0.62 compared to an industry average of 0.80.
So again, lower than average. It suggests they might struggle a bit with immediate cash needs.
It's definitely a potential warning sign. Less wiggle room if something unexpected happens. Worth watching.
Got it. Next up, solvency. This is more long-term health.
Exactly. Can they meet their long-term obligations? How reliant are they on debt?
G Company's debt-to-equity ratio was 0.92 in year two.
Meaning for every dollar of equity, they have about 92 cents of debt. It's less debt than equity, which is generally seen as less risky.
And the total debt ratio was 0.48.
So about 48% of their assets are financed by debt. Creditors own almost half the company's assets, essentially.
Okay. And finally, those performance metrics, like from an investor viewpoint.
Yeah, like earnings per share, EPSG companies was $2 in year two.
Straightforward enough. And the price to earnings, or PE ratio, was 6.
Right. So the market price of their stock was 6 times their annual earnings per share. A PE of 6 is, well, it can be seen as low in many markets.
Meaning investors aren't paying a high premium for their earnings, maybe lower growth expectations.
Could be. Or maybe the market thinks it's undervalued. Like we said, it prompts more questions.
Okay, let's switch gears to variance analysis, comparing actuals to budget.
Yeah, this is huge for control and planning. The Neostar example showed this well.
Right, they had unfavorable revenue variance, unfavorable contribution margin, but favorable variable expense variance initially.
But that's where you need the flexible budget, because maybe they sold fewer units, so of course total variable costs were lower. Was it lower per unit?
So the flexible budget adjusts the plan to the actual activity level, like what should costs have been for the number of units actually sold?
Exactly. Neostar probably found out that even though total variable costs were down, the cost per unit might have been higher than planned. And maybe the selling price per unit was lower too.
So the flexible budget comparison gives you a much clearer picture of why you missed the overall profit target. It isolates price issues from volume issues.
Precisely. Variance analysis helps you pinpoint where things went off track from the plan.
Good stuff. But we should mention limitations, right?
Yeah.
Ratios depend on the accounting data.
Absolutely. Garbage in, garbage out, estimates, different accounting methods, historical cost versus fair value. It all impacts the ratios.
And one ratio alone doesn't tell the whole story. You need context.
Definitely. Looking at trends over time, that's horizontal analysis. And looking at how items stack up within 1 year, like percentage of assets, that's vertical analysis. They add richness.
So wrapping up, ratios and variance analysis, they're powerful tools, quick ways to assess health, performance, efficiency.
And spot deviations from the plan. They give structure to your analysis.
So here's a thought to leave you with. Knowing just a bit about this now, how might Looking at, say, a company's current ratio or thinking about actual versus budget change how you read business news.
Or even how you approach your own finances. What questions pop into your head now when you hear about a company's performance? Something to think about.